China isn't just buying gold anymore. It now wants to hold everyone else's as well. Beijing is pitching itself as custodian of foreign central bank reserves, offering vault space in Shanghai and Hong Kong as an alternative to London and New York. If it works, this isn't just another gold story. It's about who writes the rules of global finance, who decides what counts as collateral, and whether the dollar can keep its grip on the system. Today, we're going to look at what China is really doing, why it matters, and how far it can go. There's news this week that China is actively courting foreign central banks to buy gold and store it in China through the Shanghai Gold Exchange. This isn't some think tank rumor or a long-term aspiration. It is a live initiative from the People's Bank of China, which has been in talks with at least one Southeast Asian nation. The SG has also just opened its first offshore vault in Hong Kong, with contracts deliverable there. A practical step to internationalize flows and to make China a more credible player in the global bullion market. For decades, the world has had three major centers of gold trading: London, which dominates the over-the-counter market; New York, where the futures volumes set the tone; and Shanghai, which is the world's largest physical exchange, but remains overwhelmingly domestic in nature. Now, China wants that to change. It already wears many hats in the gold market. It's the largest miner, it's a huge consumer, and a central bank that has bought steadily for 9 months in a row this year alone. Now, what it lacks is a true bullion banking system and the ability to attract foreign reserves into its custody. And that is the gap that it is now trying to close. China's pitch is simple. Instead of relying exclusively on London and New York, which operate under Western political and legal frameworks, countries can place new reserve purchases inside China. So it is important to underline that this is not about moving legacy reserves out of London's vaults, which would be politically and practically contentious. Instead, it's about new flows, a way of growing China's footprint without demanding disruptive transfers. Now, the timing here is deliberate, because ever since the freezing of Russia's reserves in 2022, central banks have been uneasy about keeping all of their assets in Western custody. That shock led to the largest wave of central bank gold purchases since the late 1960s. Gold has since doubled in price, and the official sector remains a consistent buyer. China is offering something that London cannot: custody in a jurisdiction that is insulated from Western sanctions. For countries that already clear trade in yuan or rely on Chinese finance, the offer is not theoretical. It's an extension of relationships that are already there. But the obstacles are equally clear. Trust and liquidity still sit firmly with London. The Bank of England holds over 5,000 tons of sovereign gold, and London's bullion market has centuries of case law and established standards behind it. If you need to move metal quickly or lease it into the market, London is still the default. By contrast, Shanghai has often traded at a discount. Exports remain tightly controlled, and the yuan is not freely convertible. Until those frictions are eased, China will not displace London. And this is why the Hong Kong vault matters. It creates a bridge for international delivery and a place where foreign central banks can dip a toe in without committing to custody inside the mainland. But the credibility test will be practical. Will a foreign central bank publicly disclose that new reserves are being held at the SG International Board? Will those reserves be withdrawable on demand without delay or political intervention? Until there is a clear precedent, most sovereign managers will wait and watch. But what makes this initiative significant is not just storage. Goldfix over on Substack has done some great work on this. Custody attracts flow. Flow builds liquidity, and liquidity is the foundation of collateral. Because China understands that if it can capture new sovereign purchases and channel them through its exchange, well, then it lays the groundwork for something larger: the potential to use gold more actively in funding markets. There has been speculation that SG warrants could be digitized and used in repo transactions, creating an alternative to US Treasuries as collateral inside a BRICS-centric system. Now, at this stage, that remains speculative. Gold is not classified as a HQLA asset under Basel rules, and there has been no regulatory change to suggest otherwise. But the direction of travel is clear. And this brings us to the wider BRICS agenda. Much has been written about de-dollarization and multipolarity, but at its core, the project is about financial inclusion at the level of sovereign states, For too long, emerging economies have been allowed to participate in the system, but not shape it. Their savings and trade have been routed through Western banks, settled in dollars and parked in treasuries. They have been users of someone else's infrastructure. By creating custody, payment rails, and eventually collateral frameworks around gold, well, then BRICS economies are trying to design platforms that they can actually govern. The parallel with household financial inclusion is striking. In many countries, gold has been the bridge that brought people into the formal banking system. When a family in Vietnam or Indonesia uses jewelry as collateral for a loan, or when a bank in Turkey offers a gold savings account, well, trust in gold becomes the entry point to trust in banks. And now the same logic is playing out in geopolitics. Gold is the asset that can pull countries into alternative systems, not because it's fashionable, but because it is trusted and beyond the reach of a single jurisdiction. So where does this leave the market today? Well, the immediate effect is modest. A handful of central banks may place new purchases with Shanghai or Hong Kong, especially in Southeast Asia or the Gulf. For London, well, the impact is limited. It remains the deepest and most liquid market, and in moments of stress, it will still be the place where gold moves fastest. For gold prices, the effect is quietly supportive. Every new sovereign purchase, wherever it is custody, keeps the official bid under the market. The critical points to watch over the next year are very straightforward. First, whether a named central bank confirms new holdings placed at the SG International Board. Second, whether Hong Kong delivery volumes start to scale, showing that the offshore platform has traction. And third, whether China eases export restrictions to give foreign reserve holders real confidence that they can take metal out again if they need to. Now, without those developments, well, the initiative will remain more of a signal than a shift. The bigger story is, as always, is strategic. By building custody options and offshore vaults and digital warrant systems, China is laying the foundations of a parallel market infrastructure. It will not replace London and New York overnight, but it does not need to. Even a small share of new flows would mark a break with the post-war norm that all roads in bullion lead to the West. And for investors, the message is simple. Central banks remain net buyers and they are looking for diversified custody that is bullish for gold on any reasonable horizon. But the plumbing matters as much as the headlines. The address where reserves sit is becoming a policy choice, and policy choices, they shape flows. So the story here is not that China has dethroned London, because it hasn't. The story is that China is creating the option of an alternative channel, one that appeals to countries looking for sanctions, resilient storage, and closer ties with Beijing. Whether that option becomes mainstream depends on practical credibility, not declarations. The next 12 months will show whether China can turn into a diplomatic pitch into a functioning market. And if you want to take control of your gold and take control of the system as much as you can, then why not click on the link below and download one of our guides?